Welcome to Talk Tickers. So right now, the absolute titans of Wall Street are quietly taking the $37 trillion US Treasury market, and they're moving it onto the exact same decentralized technology that powers, meme coins.
Right. And it's wild because it sounds like a joke, but it's not.
No, not at all.
No.
We are looking at some fun crypto experiment today. We are watching the total fundamental replacement of the global economy's plumbing. And it's happening right under our noses while the water's still running.
Exactly. I mean, you take this completely disruptive, decentralized architecture and you wrap it in the most boring, universally accepted financial instrument on earth, right? The short-term US Treasury bill.
The ultimate disguise.
It really is. It's the perfect disguise for a financial revolution. This isn't theoretical anymore. We're literally watching the largest asset managers in the world physically move sovereign debt onto public blockchains.
So let's establish a really rapid, high-level summary of what we're actually talking about here when we say tokenized treasuries. Mm-hmm. Just to define them clearly for you, these are digital representations of U.S. government bonds that exist on a blockchain.
Right. They combine that quote-unquote risk-free yield of traditional finance with the 2047 instantaneous on-chain efficiency of the crypto ecosystem.
But, if you are managing a portfolio right now, or if you're a corporate treasurer listening to this deep dive, you might be thinking, wow, I already have digital dollars. You use stablecoins every day to move capital.
Sure, people think USDC or Tether covers this.
Exactly. But we have to separate a stablecoin from a tokenized treasury immediately because the capital efficiency difference is just staggering.
It's night and day.
It really is. Yeah. Think of a stablecoin as well, not as a checking account, but like a non-interest bearing corporate sweep account. It's highly liquid. It's great for moving value instantly, but it pays you exactly 0% interest.
Right, because the issuer of that stablecoin takes your fiat dollars, they buy US Treasuries, they earn that 4.5% or 5% yield, and they just pocket the entire spread.
Yeah, that is their core business model.
But a tokenized treasury, conversely, operates like a direct sweep into an institutional government money market fund. You hold the digital token in your wallet, and that 5% yield is passed directly back to you.
Right. The issuer isn't capturing the spread. They're just charging a transparent management fee.
Exactly. So for a fund holding hundreds of millions in dry powder on-chain, shifting from a stablecoin to a tokenized treasury is literally the difference between bleeding to inflation and generating massive risk-free operational runway.
Which is huge. So on this deep dive, we're going to unpack exactly how mega institutions like BlackRock are engineering this transition. We'll analyze the brutal structural war currently being waged for market share in this space.
Yeah, specifically looking at why first mover advantage is totally failing against superior underlying code.
Oh, that part is so fascinating. We're also going to explore the theoretical and mathematical limit of what's called zero settlement risk. And finally, because we always look at the downside here, we're going to expose the hidden systemic traps.
The liquidity illusions.
Yes, the liquidity illusions and the bankruptcy risks that you absolutely must watch out for before allocating a single dollar.
You really have to understand the risks.
So to understand how these complex instruments function, we have to look at the macro catalyst that forced them into existence. Because the financial industry doesn't just, adopt complex new infrastructure for the fun of it.
No, they hate changing the plumbing. It costs money.
Right. So the catalyst was this massive macro shift that hit its boiling point in early 2023, specifically with the collapse of Silicon Valley Bank.
Yeah, you really have to step back and look at the environment leading into that specific weekend in March 2023. We had just violently exited the era of zero interest rate policy.
The end of ZIRP.
Exactly. For over a decade, holding cash paid virtually nothing. So capital was forced further and further out on the risk curve just to find any kind of return.
But then inflation spikes, the Federal Reserve hikes rates at a historic pace, and suddenly the risk-free rate is sitting around 5%.
Right. And in that environment, holding cash actually generates a meaningful, necessary return for any business.
But here's the problem. Web3 companies, crypto hedge funds, decentralized autonomous organizations, they were completely trapped.
They had billions of dollars in operating capital, but the traditional banking sector was incredibly hostile to them.
They were congregated in just a handful of tech-friendly regional banks.
Yeah.
And then the SVB bank run triggered.
Total panic.
Let's actually walk through the exact terror of that weekend for a corporate treasurer. It's Thursday afternoon. You start seeing these rumors on Twitter. You try to initiate a wire transfer to pull your operating capital out of SVB, but bam, you hit the 4.00 p.m. wire cutoff.
The worst feeling in the world.
Your money is just stuck. You realize your deposit is an unsecured liability of a commercial bank that might not even open its doors on Monday.
And even worse, if you held stablecoins, you suddenly realize the stablecoin issuer had their cash reserves trapped in that exact same failing bank.
Right. The counterparty risk of the commercial banking layer was suddenly radioactive.
That weekend was the exact moment the theoretical need for on-chain safety became an actual existential requirement. The panic wasn't just about losing access to funds.
It was a wake-up call.
It was the stark realization of how fractional reserve banking actually works under stress. Like, when you have a standard bank deposit, you don't actually own the cash in a vault. You own an IOU from the bank.
Right. And if their loan book goes toxic, which in SVB's case, ironically, was because they held long-duration treasuries that lost value as rates rose, your deposit is at risk.
Exactly. So by moving capital into a tokenized treasury, these funds figured out they could actively bypass the fractional reserve banking system entirely.
Because if you own a tokenized T-bill, you have a direct claim on a segregated, bankruptcy remote U.S. government asset.
You're insulated from the commercial bank's balance sheet. If the custodian bank fails, your asset is still sitting there untouched, just waiting to be transferred to a new custodian.
So that flight to safety solved the counterparty risk.
Yay.
But the other half of the equation, and really the reason this asset class didn't just survive the SVB crisis, but it absolutely exploded afterward, is the eradication of dead capital.
Oh, dead capital is the bane of institutional trading.
If you've ever managed a trading desk, you know the physical pain of traditional market friction. Let's look at a practical scenario. It's 6:00 p.m. on a Friday.
A dangerous time.
Right. A massive geopolitical event occurs, or there's some severe dislocation in the crypto derivatives market. You see this generational arbitrage opportunity, but your firm's cash is sitting in a traditional money market fund.
Which means you are completely stuck.
Because that traditional T-bill settles on a T+1 basis, meaning 1 business day later. But traditional markets closed at 4:00 p.m. Eastern. They do not open on weekends.
They completely shut down for bank holidays.
Exactly. You are mathematically paralyzed. Your capital is dead until Monday morning.
And in modern, algorithmic, globally connected markets, waiting until Monday morning means the opportunity has completely evaporated.
The alpha decays in minutes, not days.
Right. But the blockchain, however, operates continuously. It has no closing bell.
So by tokenizing that treasury bill, you literally turn a T+1 settlement into a T0 settlement. It becomes atomic, instantaneous.
You can transfer $50 million of yield-bearing U.S. government debt from a multi-signature wallet in New York to a proprietary trading desk in Singapore at 2:00 a.m. on a Sunday.
And the cryptographic settlement takes what, roughly 12 seconds?
12 seconds, and the finality is absolute.
The market grasped this paradigm shift instantly. I mean, the tokenized treasury sector surged past $7.3 billion in total value locked by early 2025. That was over 250% year-over-year growth.
And it has now crossed the $10 billion threshold.
We're no longer talking about a niche experimental garage project. The absolute heavyweights of global finance recognized the multi-trillion-dollar ceiling of this technology, and they stepped in to build the institutional infrastructure.
The adults are in the room now.
They really are. So let's break down the architecture built by the 800-pound gorilla of global finance, BlackRock. They launched the BlackRock USD Institutional Digital Liquidity Fund.
And they chose the ticker symbol BUIDL, which is spelled BUIDL.
Which is clearly a cheeky nod to the crypto HODL culture.
Yeah, it's a fun ticker, but the meme-friendly name is basically a Trojan horse. This is a strictly institutional, heavily fortified product.
It requires a $5 million minimum investment, and it is legally restricted to U.S. qualified purchasers only.
But despite those massive friction points, it rapidly amassed roughly $2.9 billion in assets under management.
The success of BUIDL really comes down to its structural engineering. It operates on what we can describe as an iron triangle.
Right. It relies on 3 distinct pillars working in constant synchronization to satisfy both strict SEC regulators and crypto-native hedge funds.
So let's break those down. Pillar 1 is BlackRock itself.
They operate purely as the traditional asset manager. They do not touch the cryptography.
They manage the actual portfolio, making sure 100% of the fund's assets are invested in short-term U.S. government securities, fiat cash, and overnight repos to maintain that stable $1 net asset value.
Then you have Pillar 2, which is securitize. They act as the digital transfer agent and the compliance gateway.
Because in the traditional world, a transfer agent keeps the master ledger of who owns what stock, right?
Exactly. But in the tokenized world, Securitize maintains a cryptographic whitelist. They run the complex know your customer and anti-money laundering background checks.
And once you clear those checks, your specific blockchain wallet address is added to the smart contracts whitelist.
And if an address is not on that list, the Ethereum network mathematically rejects any transfer of the BUIDL token to it. It just won't work.
Which brings us to Pillar 3, which grounds the entire operation in physical reality, BNY Mellon.
They serve as the traditional, highly regulated custodian. They hold the actual physical US Treasury bills and the fiat cash in their off-chain vaults.
So let's walk through the precise mechanics of how capital actually flows into this iron triangle. Say you're that corporate treasurer we mentioned earlier.
Yeah.
You want to allocate $10 million into BUIDL.
First, you wire traditional fiat US dollars through the legacy banking system to BNY Mellon.
Securitize monitors that account, sees the funds have cleared, and verifies your wallet's KYC status.
Then, Securitize triggers a smart contract on the Ethereum blockchain. That contract mints exactly 10 million BUIDL tokens and drops them directly into your whitelisted digital wallet.
It's one-to-one. But while the minting process is seamless, the true engineering marvel of BUIDL is actually the exit strategy. It features a revolutionary dual redemption path.
This is where it gets really interesting. The primary path is traditional. You submit a redemption request, the BUIDL tokens in your wallet are computationally burned, destroyed, and BlackRock liquidates the equivalent underlying T-bills.
Then BNY Mellon wires the fiat cash back to your corporate bank account. But this path is entirely subject to legacy friction. It takes time, usually settling T+1.
Right, so the secondary path is the breakthrough. BlackRock partnered with Circle, the issuer of the USDC stablecoin, to create a specialized smart contract that acts as an instant liquidity bridge.
This secondary path completely alters how institutions manage risk. You can take your yield-bearing BUIDL tokens and swap them directly into liquid USYC stablecoins at, say, 3:00 a.m. on a Saturday.
Circle is effectively acting as a massive, automated liquidity provider. They are fronting the USDC on the blockchain, absorbing your BUIDL tokens, and taking on the slight duration risk of waiting until Monday to settle with BlackRock in the traditional world.
So you get the 5% yield of the U.S. government, but you retain the instantaneous 247 liquidity of digital cash. It completely eliminates the concept of dead capital.
It's brilliant infrastructure.
It is. But here is where the narrative takes a really fascinating turn. BlackRock has the most dominant brand in global finance. They had the first mover advantage for scale. They built this brilliant architectural bridge.
And yet,
in January 2026, BlackRock actually lost its #1 spot in assets under management in the tokenized treasury sector. They were dethroned by Circle's own native product.
the flippening.
The flippening. By late January 2026, Circle's tokenized treasury ticker USYC hit $1.69 billion in AUM, narrowly edging out BUIDL's $1.684 billion.
And the momentum data was incredibly skewed. USYC grew 11% in just 30 days, while BUIDL actually experienced a 2.85% contraction.
So why did this happen? Because BlackRock is, well, BlackRock.
This perfectly illustrates a core truth of decentralized finance. Distribution channels and underlying collateral mechanics will defeat pure institutional brand recognition every single time.
So to understand exactly why USYC overtook BUIDL, we have to look closely at the operational plumbing of crypto derivatives markets.
In July of 2025, Binance, which handles the largest volume of crypto derivatives in the world integrated circles USYC, to be used as off-exchange collateral.
And BlackRock's BUIDL didn't secure that specific integration until November.
Right. And that 4-month gap is a literal lifetime in digital asset markets. USYC became deeply embedded directly into the operational layer where massive institutions and high-frequency trading firms automate their margin requirements.
Let's actually break down the exact math and the engineering headache of why algorithms prefer one token over the other, because it really comes down to structural differences in how the yield is paid out to the holder.
It's a huge operational difference. BUIDL operates on what is called a distributing yield model.
meaning the smart contract is programmed so that the price of one BUIDL token is pegged permanently at exactly $1.
Yes. As the underlying treasury bills held at BNY Mellon earn interest throughout the month, that value accumulates off-chain. At the end of the month, the smart contract mints brand new BUIDL tokens representing that accrued interest and just airdrops them directly into your wallet.
It operates exactly like a traditional monthly dividend.
Circle's USYC, however, uses an accumulating yield model. No new tokens are ever minted or dropped into your wallet.
So if you buy 100 tokens, you will only ever have 100 tokens.
Exactly. Instead, the actual nominal price of the USYC token slowly ticks upward continuously, from $1 to $1.01 to $1.02, precisely reflecting the accrued interest of the underlying assets.
Now, if you are an engineer building a margin engine for an exchange, a distributing token is an absolute nightmare.
A total nightmare, because a margin engine needs to constantly, millisecond by millisecond, calculate the value of a trader's posted collateral against the value of their open leveraged positions.
Right. So if a trader is using a distributing token like BUIDL as collateral, their token balance is static all month, but the off-chain yield is accruing.
So the exchange has to build custom logic to track that shadow yield. Then at the end of the month, a sudden spike of new tokens just appears in the wallet.
And the algorithm has to instantly reconcile this external airdrop, recalculate the total collateral value, and ensure it doesn't accidentally trigger or prevent a liquidation incorrectly. It introduces so much unnecessary operational complexity.
But an accumulating token like USYC solves that entirely. The margin engine simply queries an oracle for the current price of the token block by block.
The value compounds internally. It's a mathematically clean, set and forget balance. The collateral value naturally drifts upward in perfect sync with the yield.
So USYC won the derivatives collateral war because its code was inherently friendlier to the trading infrastructure.
But we also have to look at the massive difference in the access funnel here. BlackRock built a regulatory fortress. BUIDL's $5 million minimum and strictly U.S. qualified purchaser requirement functionally cuts out 99% of the global crypto market.
Circle engineered USYC for global distribution. They lowered the minimum requirement to just $100,000. And critically, they specifically targeted non-US investors.
By establishing an offshore compliance framework, Circle captured the massive, highly liquid offshore crypto ecosystem.
There are hundreds of offshore family offices, crypto-native prop desks, and international hedge funds that possess billions in operating capital.
And they desperately need safe, yield-bearing dollar-denominated collateral to back their complex trades. But they legally cannot step through BlackRock's narrow onshore regulatory gate.
So Circle provided the exact same underlying asset short-term US Treasuries, wrapped in an accessible, composable offshore token.
But regardless of whether you are trading the onshore BUIDL or the offshore USYC, moving billions of dollars of institutional capital requires the underlying blockchain technology to be completely bulletproof.
You absolutely cannot run an institutional money market fund on the same basic code used to launch a meme coin.
Wall Street requires total control. That meant the foundational code of Ethereum had to be heavily customized to support legal compliance. So let's examine how the actual token standards evolved to make this possible.
It really tells the story of how decentralized tech compromised with centralized law. The foundational layer of the Ethereum ecosystem is the ERC-20 standard.
Which was the protocol that fueled the massive initial coin offering boom back in 2017.
Exactly. Its primary feature is that it is completely permissionless. Anyone can deploy an ERC-20 token, and anyone can send it to any other wallet on the network. It has absolutely zero transfer controls.
It's entirely blind to legal compliance, which is exactly what makes regulators break out in hives. Because if you issue a digitized security on an ERC-20 standard, a North Korean hacking syndicate could theoretically steal it and freely trade it on a decentralized exchange.
Precisely. The industry realized this and developed the ERC 1400 standard, specifically designed for security tokens.
And that introduced the concept of partition balances, right?
Yes. This meant an issuer could technically lock up specific tokens in a user's wallet for a mandated vesting period, and it supported anchoring legal documents, like a prospectus, directly to the token's metadata.
But the bleeding edge of institutional tokenization right now utilizes concepts found in the ERC 3643 standard.
The identity-aware standard. It enforces dynamic, real-time compliance via off-chain oracles.
Let's actually explain how dynamic compliance functions in practice, because this is where the blockchain starts acting like a traditional compliance officer.
Sure.
Imagine you're trying to send $10 million in tokenized treasuries to a counterparty. You hit send. Before the blockchain actually executes the transfer, the smart contract pauses.
It queries an off-chain compliance oracle, essentially a secure connection to a real-world database.
Right. It checks both your identity and the receiver's identity against real-time global watch lists.
So if the receiver's wallet address was flagged by the Office of Foreign Assets Control OFAC, say, 5 minutes ago because it was linked to a sanctioned jurisdiction, the oracle reports that back to the smart contract.
And the smart contract immediately mathematically blocks the transaction mid-flight. The transfer just fails.
BlackRock utilizes a heavily customized permissioned architecture for BUIDL that relies on this exact type of centralized control. Securitized manages a strict whitelist at the smart contract level.
But this level of control introduces a feature that is deeply controversial for crypto purists. Because BUIDL is a registered security managed by a licensed transfer agent, it is not a pure bearer asset like Bitcoin.
Right. If you lose the private keys to your Bitcoin wallet, that wealth is mathematically locked away forever. There's no customer service number to call.
Exactly. But if a corporate treasury loses the private keys to their BUIDL wallet, or if the wallet is compromised by a malicious actor, they can contact Securitize.
They prove their corporate identity in the real world through legal documentation.
And then Securitize has the unilateral cryptographic authority to go into the smart contract, permanently burn the tokens sitting in the frozen or compromised wallet, and reissue brand new tokens to a newly secured wallet.
For institutions managing hundreds of millions of dollars of client capital, taking on binary key loss risk is a fiduciary impossibility. The ability to burn and reissue tokens is a mandatory feature for them.
But we have to acknowledge that this is a direct blow to the original trustless, decentralized ethos of cryptocurrency. It proves that this new financial plumbing is still heavily reliant on trusted, centralized intermediaries who hold the ultimate kill switch.
It's a trade-off they have to make.
But this raises a massive technical question. We keep talking about smart contracts making decisions based on real-world data. How does the blockchain, which is basically an introvert living in a dark room with no windows, only aware of its own internal ledger, how does it actually know that the physical T-bills are sitting safely in BNY Mellon's vault in New York?
Because the Ethereum network cannot log into a traditional bank portal to check an account balance.
Right. So how does it know?
You've just outlined what computer scientists call the oracle problem. A blockchain is a closed deterministic system. It cannot natively verify anything that happens outside of its own network.
So if a token is supposed to represent a physical asset off-chain, you have to introduce a mechanism to feed that external data onto the ledger without relying on a single, centralized point of failure that could be bribed or hacked.
And to solve this, the tokenized treasury market relies heavily on decentralized oracle networks, specifically the infrastructure built by Chainlink. They provide a vital service called proof of reserve.
Let's detail the exact mechanics of proof of reserve. Think of it as an automated, continuous, cryptographic auditor.
Instead of trusting BlackRock's word that the assets are in the vault, a decentralized network of independent node operators securely and constantly queries the off-chain banking APIs of the traditional custodian BNY Mellon.
These nodes independently verify the actual fiat and security balances held in the traditional vault.
They aggregate that data, reach a consensus on the exact dollar amount, and then report that verified data directly onto the blockchain in a tamper-proof smart contract.
And the BUIDL smart contract is mathematically bound to that oracle data. This fundamentally changes the trust model of finance.
It really does. If an issuer somehow attempted to maliciously mint more tokenized treasuries than they had physical T-bills backing them, basically attempting to run a fractional reserve, the smart contract would instantly detect the discrepancy.
Because it sees the difference between the on-chain token supply and the off-chain reserve data provided by Chainlink.
And the contract is programmed to automatically hard pause the minting function. It mathematically prevents fractional reserve greed.
You are no longer trusting the integrity of the bank. You are trusting the verifiability of the code. And because this oracle infrastructure is so robust, it allows these tokens to safely break out of their native ecosystems.
Right. BUIDL doesn't just live on Ethereum anymore.
Through cross-chain messaging protocols, specifically Chainlink's CCIP and systems like Wormhole BUIDL, has expanded to exist simultaneously on multiple blockchains, including Avalanche, Polygon, and Solana.
And this expansion isn't just a marketing gimmick, it is highly strategic. Moving to Solana, for instance, allows high-frequency trading terms to utilize BUIDL as collateral in environments capable of processing thousands of transactions per second with fractions of a penny in gas fees.
It creates a unified, interoperable layer of sovereign-backed collateral across the entire fragmented crypto ecosystem.
But if we connect this architecture to the broader macroeconomic picture, we aren't just talking about making offshore crypto trading more capital efficient.
No, the highest levels of traditional finance are watching this closely. Federal Reserve researchers are actively studying this exact architecture because the theoretical frontier of this technology, the ultimate goal, is the total eradication of settlement risk in traditional global finance.
Which would be monumental.
Let's dive deep into that concept. Federal Reserve researchers have published extensive analysis on what they term zero settlement risk token systems. What does that actually mean for the plumbing of Wall Street?
Well, the researchers identified a fatal structural flaw in our legacy financial system. We separate the act of trading from the act of settlement.
Okay, so when you execute a trade to buy a corporate bond on a traditional terminal today, the agreement happens instantly.
But the actual settlement, the complex back-end process of transferring the fiat cash from your clearinghouse to the seller and transferring the legal ownership of the bond from their custodian to yours, happens days later.
And that time gap creates systemic vulnerability. It creates settlement fails.
Exactly. In the 2 days it takes to settle the trade, a counterparty could go bankrupt, a massive market shock could occur, or a party could simply renege on the deal because the price moved against them.
So the legacy system requires massive clearinghouses to absorb that counterparty risk during the waiting period.
But the researchers propose that a tokenized system utilizing a dynamic ledger could fundamentally achieve zero settlement risk.
Let me translate how a dynamic ledger operates. It represents ownership that is mathematically contingent on specific states over time, and it pairs directly with smart contracts that execute immediately based on verifiable claims.
Meaning, the exact moment two counterparties agree to a trade, the smart contract locks the execution logic into the blockchain.
It enables what we call atomic swaps. If you and I agree to trade $10 million in a tokenized treasury for $10 million in a token of stablecoin, the exchange is mathematically simultaneous.
The smart contract ensures that my asset only leaves my wallet if and exactly when your asset leaves your wallet.
There is no 2-day time gap. There's no clearinghouse acting as a middleman absorbing risk. The trade is the settlement.
Therefore, no one is ever left holding the bag if a counterparty defaults mid-transaction. Settlement risk drops to literal zero.
That is the holy grail of financial plumbing. And it unlocks a concept that completely rewires how we think about capital efficiency. Collateral velocity.
Oh, this is the best part.
Let's build a scenario to really visualize how powerful collateral velocity is. Imagine a massive quantitative hedge fund. Let's call them deep dive capital. They're holding $100 million in traditional US T-bills, quietly earning their 5% yield.
Okay.
It's a Saturday afternoon. Suddenly their algorithms detect a massive fleeting arbitrage opportunity in the global currency markets. In the old legacy world, what happens?
In the legacy world, deep dive capital is functionally paralyzed. To get the raw cash needed to execute that new arbitrage trade, they would have to sell their T-bills.
But because it's Saturday, the bond market is closed.
Right. And even if they could find an over-the-counter buyer willing to take the other side of the trade, the transaction wouldn't settle and the cash wouldn't be available until Monday or Tuesday.
By the time the cash arrives, the arbitrage window has completely closed.
Yeah.
They miss the opportunity entirely because their collateral is moving at the speed of the 1970s banking system.
Exactly. Now, put deep dive capital in the tokenized world. They have $100 million in BUIDL or USYC tokens. They see the exact same arbitrage opportunity on Saturday afternoon.
Instead of trying to sell the T-bills, they take those tokens and pledge them instantly into a decentralized finance lending protocol, an autonomous DeFi smart contract.
They post the $100 million in tokenized T-bills as collateral. The smart contract instantly verifies the value via the Chainlink oracle and allows them to borrow $80 million in USDC stablecoins against it.
They take that $80 million, execute their massive arbitrage trade, capture the profit, and here is the absolute kicker. They keep earning the 5% yield on the underlying T-bills the entire time they are pledged as collateral in the smart contract.
The entire sequence happens in seconds on a weekend without ever speaking to a prime broker, a bank, or a clearinghouse. That is the definition of collateral velocity.
The exact same pool of capital is functionally doing two things at once, safely and transparently tracked, on a public ledger. Now, I have to push back here.
Go for it.
Because as someone who understands market blowups, when you describe borrowing $80 million against collateral to make another trade, you are describing hyperspeed leverage. And opaque leverage is precisely what blows up the global financial system. Isn't building a 247 automated leverage machine incredibly dangerous?
It's a vital question. Yes, it is leverage. But to understand the risk profile, we have to realize that this exact type of leverage already exists at a massive scale. It perfectly mirrors the traditional repo market, the repurchase agreement market.
Right. The traditional repo market is a multi-trillion-dollar shadow banking machine. Every single night, major banks and hedge funds swap treasuries for cash to grease the wheels of Wall Street and then reverse the trade the next morning.
It's highly opaque, it relies heavily on manual intervention, and it operates entirely on the trust between massive financial institutions.
So what the tokenized ecosystem does is take that opaque, banker-driven repo market and forces it into the light. It makes it entirely transparent on a public ledger, available 204/7 and ruthlessly efficient.
And the efficiency comes from the smart contract liquidations.
Exactly. In the traditional world, if a hedge fund's trade goes bad and the value of their collateral drops below the required margin threshold, a prime broker picks up the phone.
They issue a margin call. They might grant the fund a grace period of a few days to wire more cash.
And that grace period introduces immense systemic risk, which is exactly how the Archegos Capital collapse infected multiple global banks a few years ago.
But in the tokenized DeFi repo market, there is no phone call. There is no grace period.
If Deep Dive Capital's collateral value drops below the hard-coded threshold, the smart contract ruthlessly and mathematically liquidates their tokenized treasuries instantly, selling them to arbitrageurs to make the lending pool whole.
It is a brutal system, but structurally, it is incredibly safe for the lender. It removes the human element of leniency that usually precedes a contagion event.
And this dynamic ledger technology goes even further. Federal Reserve research points out that this architecture could completely disintermediate the traditional securitization market.
That's a massive shift.
Think about how Wall Street structures products today. If you want to take the cash flows of a 10-year Treasury bond and strip them apart, separating the principal payment from the semi-annual interest payments to create Treasury strips, you have to pay a massive dealer intermediary to package them, legally structure them, and sell them to you.
With dynamic ledgers, you could take a tokenized bond, run it through a smart contract that mathematically unbundles the cash flows, and trade the individual interest payments peer-to-peer instantly.
You completely bypass the intermediary. You functionally become your own investment bank structuring desk.
It democratizes the power of complex financial structuring, placing it directly into the hands of anyone utilizing a compliant wallet architecture.
Okay, we have painted a highly utopian picture so far. Atomic settlement, ruthless algorithmic efficiency, 247 liquidity, democratized securitization, and the eradication of dead capital. But it is time to pour some cold water on this thesis. Because this new financial plumbing has some massive hidden weak points that are not widely discussed, we need to expose the systemic risks.
And the most glaring systemic trap currently built into this architecture is what market analysts refer to as the Sunday night problem. It's the profound danger of a structural liquidity mismatch.
Let's set the scene for the Sunday night problem. What exactly happens when the two systems collide?
Let's imagine a highly plausible nightmare scenario. It's 11:00 p.m. on a Sunday night. Traditional global markets are closed tight. Suddenly, a catastrophic event occurs in the crypto space.
Perhaps a massive offshore exchange gets hacked, or a major systemically important stablecoin begins to lose its dollar peg.
Absolute panic sets in. Hedge funds, proprietary trading desks, and retail whales suddenly receive massive automated margin calls across their decentralized finance positions.
They desperately need raw, liquid cash stablecoins to avoid being ruthlessly liquidated by those smart contracts we just talked about.
So everyone rushes to the exits at the exact same time. They attempt to redeem their tokenized treasuries, their BUIDL or USYC tokens, to get cash.
But the primary redemption mechanism, the traditional banking window, is nailed shut. BNY Mellon, the traditional custodian holding the actual fiat cash and the physical T-bills, is closed until Monday morning.
BlackRock cannot liquidate the underlying assets. The primary pathway to convert that token back into fiat is entirely choked off.
The foundational layer of liquidity is frozen by legacy banking hours. But wait, earlier we discussed how BlackRock built that secondary redemption path. They partnered with Circle to create a specialized USDC smart contract for instant 24/7 redemption. Doesn't that bridge solve the Sunday night panic?
It only solves the panic if Circle or whatever secondary liquidity provider is operating the bridge is willing and able to absorb the massive wave of toxic flow.
Because when you use that instant redemption contract, Circle is essentially fronting their own USDC reserves, absorbing the BUIDL tokens, and taking on the trust assumption that they can redeem those tokens with BlackRock when the traditional banks open on Monday.
But in a severe cascading market panic, third-party liquidity providers are not charities. They operate on risk models. If the panic is severe enough, they will step back.
They will literally pause their smart contracts to protect their own balance sheets from being drained of liquid stablecoin.
And if that instant redemption bridge is pulled, you are trapped in a massive liquidity vacuum.
So structurally, the tokenized treasury is perfectly safe. The physical U.S. government bond is sitting securely in a vault in New York, completely untouched by the crypto crash.
Yes.
But your real-time access to its value is completely severed.
And because of that severe liquidity mismatch, a terrifying dynamic occurs. In a Sunday night panic, funds facing instant smart contract liquidation cannot wait until Monday morning.
They are forced to sell their tokenized treasuries on secondary, peer-to-peer decentralized exchanges at a heavy discount, just to secure whatever stable coins are available.
You could witness a scenario where a digital token backed one-to-one by a pristine U.S. government bond temporarily depegs and trades for 90 or 85 cents on the dollar.
Not because the underlying asset is impaired, but simply because the traditional banking rails are asleep while the crypto rails are burning.
That is a terrifying structural trap.
Yeah.
You're holding the safest asset in the world, but the plumbing temporarily strips it of its liquidity precisely when you need it most.
And that brings us to the other massive hurdle, capping the explosive growth of this sector: regulatory realities. We can build all the dynamic ledgers, atomic swaps, and complex DeFi repo markets we want, but we still have to deal with the heavy hand of the SEC.
The Securities and Exchange Commission has been incredibly consistent on this specific issue. SEC Commissioner Hester Peirce has explicitly noted that putting a novel technological wrapper around a traditional security doesn't make it stop being a security.
The Securities Act of 1933 and the Investment Company Act of 1940 apply in full force to these tokenized products.
Which means this space will always carry a heavy layer of friction.
The crypto purists who dream of a totally permissionless, anonymous, globally accessible market for U.S. government debt are going to be deeply disappointed.
To comply with those 1930s era laws, these protocols require KYC data, they require centralized transfer agents managing whitelists, they require the ability to freeze and burn tokens, and they require corporate bureaucracy.
The whitelist isn't a temporary bug being worked out by developers. It is a permanent, legally mandated feature of the ecosystem.
It is the unavoidable cost of bridging sovereign debt onto a decentralized network. You inherit the incredible efficiencies, the speed, and the transparency of the blockchain, but you also permanently inherit the regulatory baggage and the jurisdictional control of the state.
Which brings us perfectly to the final segment of our deep dive. We have covered the macro mechanics, the structural market wars between distributing and accumulating tokens, the theoretical limits of zero settlement risk, and the hidden systemic traps of Sunday night liquidity crunches.
We covered a lot of ground.
We did. But now we want to leave you with a highly practical lens to view this evolving space. We call it the one question.
The most important question.
Yes. If you are a portfolio investor, a fund manager, or a corporate treasurer looking to park operating capital in a tokenized treasury product today, what is the single most important legal question you must ask the issuer before you wire a single dollar?
Here is the exact question you must ask. Does the digital token I am holding confer a direct legal claim on the underlying physical asset, or is it merely a derivative claim on a special purpose vehicle?
And explain exactly why that legal distinction matters so much.
Because in a catastrophic bankruptcy scenario, it is the exact difference between keeping your capital perfectly safe and losing it all to a tech startup's creditors.
Wow.
Yeah. If the issuer of the tokenized treasury goes bankrupt, you need to know where you stand in the capital stack. If the token represents a direct legal claim, it means you legally own the specific T-bill sitting in the custodian's vault.
So the issuer's bankruptcy does not affect you. A bankruptcy judge will simply instruct the custodian to return the asset to you.
However, if the token is merely a derivative claim on a special purpose vehicle managed by the issuer, you do not own the asset.
You are simply an unsecured creditor of the bankrupt entity. You will be standing in a very long line at a bankruptcy court, hoping to recover pennies on the dollar years down the road.
Read the fine print. The blockchain's code might be immutable, but bankruptcy law is utterly ruthless.
Now, to wrap up, I want to leave you with a final provocative thought regarding the broader macroeconomic picture. When you step back and look at what massive institutions like BlackRock are doing, it feels a bit like Larry Fink is playing 4D chess on a global scale.
Oh, absolutely.
Think about the prevailing narrative. BlackRock's CEO has publicly noted that they are taking the exact decentralized, permissionless technology that was explicitly invented by cypherpunks to bypass traditional central banking, and they are using it to upgrade, digitize, and bulletproof the US Treasury market for the 21st century.
It's the ultimate irony of financial innovation. The monetary rebels spend a decade building the high-speed rails to escape the legacy system, and the financial empire simply adopts those exact same rails to make their own system completely inescapable.
We will leave you to mull that one over on your own. As always, thank you for joining us on this deep dive. Remember, we are not financial advisors, and nothing we have discussed today constitutes investment advice. Do your own research, intimately understand the mechanics and the legal structure of what you are buying, and keep your eyes on the tape.